It's my pleasure to introduce our second presenter of today, Hubertus Clausius, portfolio manager at Seahawk Investments, who will talk to us about the attraction of shipping equities. Hubertus.
Thank you very much, Andrew, and hello everyone. Yeah, 2020 was characterized by a tremendous dispersion between growth stocks and value stocks. The recession has triggered accommodative central bank policies around the world. In the beginning of March, the Fed funds target rate was lowered from 1.5% right down to 0%. In the euro area, we had deposit rates already at negative 0.5%. So the ECB is very much engaged and even expanded its bond buying scheme, which is unprecedented at a volume of 1.35 trillion euros in June. So there's tremendous liquidity in the market, and in the PBOC in China has lowered the medium-term lending rate from 3.15% to 2.9% in the beginning of March. So this has lowered interest rates around the world and flattened yield curves, and that is an ideal environment for growth stocks. And we have all noted that there was a massive run into tech shares and also in healthcare shares. So growth shares are the ones with high earnings growth, higher multiples versus the value stock segment, which is characterized by low price to book values, high dividend yields. And just to give you an example, from the 31st of December 2019 until September 21, just yesterday's closing, the S&P 500 is still up by nearly 2%. The Russell 2000 index, which is the small cap index, is down by 10.76%. The Russell 2000 value index is down by 22.85%. And the Russell 2000 marine transportation index, which lists which is composed of the US listed shipping stocks, is still down by 43%. Well, that index excludes the big liner operators such as Maersk, which had a very good, strong performance year to date. But still, it shows that shipping is very cyclical. So in an environment of contraction, although earnings were at well mixed, but at very good levels in certain segments, this index is still down. So the question is, how attractive are shipping equities? And well, we have, as I mentioned, we have seen this huge run into growth stocks, and you see that on the left chart. You see that growth stocks have outperformed in 11 consecutive months until August. And now, in the beginning of September, as of end of last week, sort of a reallocation has happened because there has been some exuberance in tech stocks and some reallocation has taken place. And this is really due to the fact that we are perhaps getting closer to 2021, and macroeconomic indicators have, in the last 2 months, have really surprised on the upside. Economists are essentially getting more confident that we are reaching something like a base case growth scenario where world GDP growth may reach something like 5%. That is not certain, of course, if we have a second wave of the pandemic, there is a certain tail risk, but assuming we have a base case scenario in that environment, value stocks may be favored. So we have seen that type of development, and I took that chart of Bloomberg at the end of last week, and we have seen that investors have reallocated their equity holdings. So about 8% was reallocated from the growth segment into the value segment, same amount from the large cap segment to the small cap segment. And we can also see away from the expensive tech shares and also healthcare shares, which have seen a percentage-wise reduction of between 8 and 10% into the cyclicals, into industrials, and closer to the value segment. So I would assume that if let's say growth expectations are, or let's say the pandemic gets better under control, then investors will continue to watch out for value, and one of the segments that could gain, given the good fundamentals, could be the shipping segment. As I mentioned before, well, we have the various institutions giving growth forecasts. The OECD has given in September a growth forecast in a base case scenario, again, 5% in 2021. The IMF is still a little higher at 5.5%, and we all know that seaborne trade growth is closely correlated, so historically with a factor of 0.9 or close to 1 to GDP growth. So as we have heard in the previous presentation, in this base case scenario, we can expect a seaborne trade recovery in 2021. And Clarksons is actually estimating a growth rate of 5.6%. China is doing very well already during this year with a GDP, still a GDP growth of 1.8% during 2020. And expectations are that GDP growth in 2021 could reach somewhere close to 8%. So this is the positive news that in Asia we are seeing an even stronger recovery. So in this environment, shipping could be an interesting equity sector for during 2021. Yeah, how have shipping stocks performed during the pandemic? And I remember in the beginning of the year, expectations were quite negative across the board, even for the container liner segment. These forecasts for 2020 have been revised upwards, and we've been surprised when we look at particularly at Maersk and Hapag. When we look at their earnings forecast for 2020, how strong earnings are projected for the current year. So consensus estimates are for Maersk an increase in net income of 81% versus the previous year, and Hapag-Lloyd with an increase of even 40%. And then a second strongest, well, and another strong segment, of course, is the tanker segment, which benefited, of course, from the oil supply glut, which was triggered by the oil price war. So we had these very high average daily VLCC rates of $65,000 a day, which is a significant increase versus the average of $42,000 a day during 2019, and thereby the oil tanker segment has 120% higher earnings versus the 10-year average of oil tanker earnings. Then we had another strong segment, the VLGC segment, with approximately 20% higher earnings versus the 10-year average. And on the other hand, the bulker segment on the low-hand side, and also LNG carriers, bulker segment with 40% lower earnings than 10-year average, and LNG carriers with approximately 15% lower earnings than the 10-year average. But overall, we are at the higher end, 30% higher versus the first half year of the last half year earnings of the last 10 years as an average. So overall, very healthy earnings for shipping companies even during 2020. And talking about tankers again, the two largest crude tanker operators, Euronav and Frontline. Of course, given the high rate environment with an increase in net earnings of 575% for Euronav during 2020, and for Frontline of the consensus expectation is 300% versus 2019. Scorpio Tankers loss-making during the last year, but a turnaround candidate during 2020. So, of course, earnings are expected to come down next year by about 40%, but are expected to be still at a significant margin versus cash break-even rates of $25,000. I think consensus earnings for VLCCs are around $31,000, $32,000, so still at very healthy levels. Talking about the supply-demand balance and also the outlook for year 2021. First, shipping segment, crude tankers. Crude tankers are expected to face a drop in ton-mile demand by about 4%, but as we have heard in the previous presentation, demand growth is expected to be still around 5%. And versus this, we have a fleet growth which is slightly higher in 2020, 3.1%. This is why rates are expected to come down for the remainder of the year. But fleet growth, as per Clarksons, is expected to grow at 1.5% during 2021. So this is against a demand increase of 5%. So still could you just flip back to the previous slide? Thank you. Dry bulk, we see a demand drop in terms of ton miles for 2020 of 3.8% versus a fleet growth of 3.1%. during the next year, a 5.5% demand growth versus a slight fleet growth of 1.1%. So very healthy supply-demand balance for the dry bulk segment. So consensus forecast for 2021, Capesize rates as per Bloomberg are time charter equivalent rates of $17,000 a day, so 30% higher compared to 2019. With regards to the container segment, ton-mile growth is expected to contract by 5.5%. So projections have increased slightly throughout the year, and for the next year, we are expected to grow somewhere north of 6%, with a fleet growth during this year of just 1.5% and 2.9% respectively for 2019. So overall, we think that for the three shipping segments, the freight rate environment should be well supported. Coming to the order book situation. Yeah, by the classic order book size metric, we have reached the lowest level in 3 decades. Right now, the order book is even less than 10%. So in fact, this is the lowest level since 1989. If we compare that to a peak of 52% during the year 2008. So the yardstick to assess future supply growth is now at around 7.5%, so, according to Clarksons. When we look at individual years since 2008, we have seen strong ordering activity in 2010 with 158 million deadweight tons and 180 million deadweight tons in 2013. At this point in time, we are at a just during 2020, during the current year, compared to that, at 23 million deadweight tons of new orders. So that's at a very low level, and this is very much influenced by the impacts of COVID-19, yard closures, and also the market uncertainty surrounding fueling and technology choices in the future. Overall, this long-term development and the muted order activity should be a very positive for the next 2 to 3 years to come. Regarding valuation, all the shipping segments are trading at a significant discount to their NAVs. We're seeing the tanker segment currently priced, given the correction share prices, at a price to NAV of around 0.7. The bulk segment around 0.7. The LNG segment of 0.43, and the LPG segment at around 0.65. So all the shipping companies are trading below their intrinsic values. And also the question is, how are shipping equities valued compared to other small cap shares? And I've highlighted a few pricing measures. Price to book value 0.67 versus an average of 1.17 of the Russell 2000 value index. Forward earnings at 6.4 for 2021 versus 13.6 of the Russell 2000 value index. And given the high earnings, particularly in the tanker segment, we have trailing 12-month dividend yields of 7.8% versus an average of 2.77 for the Russell 2000 value index. And we also know the environment regarding bank financing, especially for medium-sized shipping companies, becoming more difficult to finance ships. And given all the factors that I have just named, we think is a very healthy environment for the next 2 to 3 years to come.
Thank you very much, Hubertus. Just very briefly, could you let us know a little bit about Seahawk Investments and what you do there?
Yeah, Seahawk Investments was set up in 2018, and we are a subsidiary of Transport Capital, which is based in Singapore. Transport Capital is an investment advisory boutique focused on transportation. And we were set up to provide regulated fund solutions. And we have launched our first long-short equity fund during 2019 that is investing in transportation and in the energy sector. And this is the first product we are managing, and so we are bringing in the expertise of our group, and to focus on this niche market, because not a lot of large fund management companies are dealing with these type of niche segments.